everyone, welcome back to Yuri's Box. In this video I'll be looking at some of the data we got these last few days, so kind of the weekly close if you will, as well as the week ahead for TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So this week was mostly up, alright? We kind of were really grinding higher for most of the week, and then we kind of gave some of it back at the end of the week yesterday. And this is actually something that isn't new to TLT. Again, if you've been following the price action, you'll know that it's nothing nothing enjoyable about it, definitely. But if you look back also at, for example, we saw last year in May, you kind of like to go up to the bull market, well, in this case, the bear market resistance band, and get up to it, kind of get close to it, and then kind of find a reason to get rejected by it, all right? And every time that we kind of get to the bull market, bear market resistance band, we generally speaking get rejected, right? That has been the story ever since, the bear market really started back in, in July of 2020, really. And usually, the rejection occurs around non-farm payroll day. Like for instance, right here in April's report, for instance, we get rejected right there. Where else is a good example? In February, all right, we got potentially another hint of that, but again, you get the picture. And this is honestly one of the things that continues to bug me, is that every time we get to the bull market or bear market resistance bands, we just find a reason to get kind of rejected. Now, I wouldn't raise the red flag just yet, given the fact that we have an important week coming up, all right? But before we get to that, I'd just like to do a roundup, if you will, of some of the data that we got from Wednesday to Friday. I didn't manage to find the time to make a video about it, but regardless, we had a huge miss on consumer confidence. Some of that was due to the fact that expectations around the labor market deteriorated. Last month we saw, some of these surveys print higher, because again, we kind of took off the worst case scenario. We went over that quite a bit. And again, if you take the worst case scenario off the table, whatever comes next is definitely more manageable. All right. So coming out of that, this month, you could have expected, numbers to generally be constructive, but that isn't really what we saw. And around the some of the labor market reads weren't that positive. Moving on, we got some more housing data, which wasn't exactly, red hot, if you to say the least. Another read on orders. Now, durable goods orders, for what I could see and what I heard, that very little that I managed to follow, is that it was a lot to do with Boeing. Right, you had a huge increase in the orders coming from Boeing. So again, Boeing shenanigans to really take the not the blame, but really that's what probably explains this huge beat on durable goods orders. Again, more read on inflation. Also, initial jobless claims came in a little bit lower, 236. Now, this is again welcome news for the economy. However, as I've been pointing out for quite a while, this is not new. Again, every time we kind of put in a peak in initial jobless claims, we kind of like to retrace lower, right? just look at the chart in front of in front of you. You can easily tell what I'm talking about. We go up, then we kind of get it back, then we move back up, give some of it back, we move back up, and then we get some of it back. I think that the peak for initial jobless claims is still ahead of us. Just like last year, again, it's been my base case ever since I started making videos that initial jobless claims would, slowly grind higher, and eventually, potentially peak in the summer. We'll see if it actually peaks in the summer, but regardless, to me, initial jobless claims again still have really a still developing story. Now, in the jobless claims day, we also had continuing claims, which were definitely not as a pretty picture as initial jobless claims. And again, we continue to push higher in continuing claims. Now, again, if you look at historical levels, historically we're still fairly benign levels. We just managed to pierce the 2000s low. We're still fairly, still below the fairly below the 06 lows. So again, it's important to keep in mind that we're still historically at quite low levels. However, the best kind of comparison that you should be making, in my opinion, is exactly just before the pandemic. And again, we continue to erode those pre-pandemic levels. All right. Right now we're at April 2017 levels, and again, if we were to pierce the 2 to 2.1 million range, we just continue to move back up and up and up and up and up. And again, continuing claims are just a proxy for how hard is it to find a job. Okay, continuing claims are moving higher. It's harder to find a job. You should expect the quits rate to remain fairly subdued, because again, if people know that it's hard to find a job, meaning that if you lose a job, you're going to stay out of a job for quite a while. Generally speaking, you'd expect people to stay put and not quit their job voluntarily. All right. So on the claims side of things, yes, we gave some of them back, but regardless of that, we are still above that kind of line of the sand. Anything above 220, you can generally expect the unemployment rate to move up, and regardless of the fact that we stayed flat, at 4.2. If you look at the unrounded number, we've been putting in, consistently over these last months, we've been going up, 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 and up. All right, slowly but surely, we've been going up. And so again, anything above 220, you can expect the unemployment rate to go up. Anything below 220, 215, you can expect the unemployment rate to stay flat, if not move lower. We have spent most of the time over that 220 line. So just like last month, I would not rule out a 0.2% increase on the unemployment rate. But that is for the my forecast, which I'll be giving in a little while. And as far as continuing claims are concerned, we continue to grind higher. Again, my kind of expectation for the summer is that we would see an increase anywhere between 2 to 2.1 million. If we continue to see this, the rate of increase stay the same in continuing claims, probably that would end up sounding quite, like quite a conservative target. So let's see how things evolve, and eventually, I'll probably have to up my my expectations. But we finished the week off with some PCE and personal income and personal spending. Now, at 2:30, we kind of had a bit of everything. 8:30 if in the US, we had a bit of everything. The inflation read came a little bit hot. All right, we had core PCE come in 0.1% higher than expected, month over month, which pushed the year-over-year higher. The PCE price index came in at expectations, but the core because of that month-over-month increase, probably, saw it go up to 2.7 as opposed to 2.6 that we were expecting. So that wasn't really great news on the inflation front, given also the fact that CPI and PPI were quite tame. So there was reason to believe at the very least that this report would also be tame. And again, it's nothing too dramatic, you know, especially if you also keep in mind that last year we really saw the inflation rate, at least on the headline, really start to move lower in June, really in June, July, August, and eventually September. All right, those were the 3 months that really started seeing inflation roll over quite severely. All right, so it isn't that much of a deal, the great deal. Also, given the fact that these last few months have generally been constructive. All right, yes, we've been bombing around 2.4, but let's not forget, or just 4 or 5 months ago, we were at 3%, and we were that in that moment of time in Twitter where we were all overlaying the 1970s on this inflation chart. So keep that in mind as well. On the other hand, personal income and personal spending weren't that great. Now, there were some shenanigans going on with, government transfers, Social Security and whatnot. Regardless, I think that this is still consistent with, everything that we've been saying, meaning that the labor market isn't really a labor market that supports, these incredible, increases in wages. And so what is awaiting us down the line is just softer demand. And potentially this is another small clue of that. But again, let's see how the data comes in, and we'll, hopefully have more clues to really make a determination here. We also got the Richmond Fed survey. Now, I'll quickly go over that. Nothing new. Again, Fifth District activity remained soft in June. Local business conditions remain solidly negative. Saw some increase in new orders and shipments. Average growth of prices paid and prices received increased in June. More or less, this was hardly news. This is just copy and paste from all the reports that we've been seeing, that we've been seeing really since February. All right, again, building on the idea that potentially the economy looks less like September to really December and January, and more like last summer, where things weren't that hot and things actually started to roll over. And so again, potentially moving back to that time of really in 2024. So where does this leave us? Well, again, the big news comes next week. All right. This is kind of a taste, if you will. We have ISM coming out. We have the JOLTS report. And who am I kidding? We're all looking for non-farm payrolls. All right. Now, in this video, I usually give my forecast for non-farm payrolls and the unemployment rate. And again, just to refresh everybody's mind, the way I kind of give my I'm just kind of giving you my personal forecast for fun and giggles here. But the way I do it is I generally go through all the PMIs, the regional surveys, and kind of come up with a number, a personal number right here. And just like in March, because like in March, I remember that there was the risk of really having a wild card. I'll refrain from giving you a number on the non-farm payrolls, simply because if you recall when we know over the PMI report, what we saw in this report is that employment generally went higher, hours went higher, and again, there was this general idea that it was just so much work because of, trying to get everything done. And really, what this report was suggesting is that there was tariff front running, that we had to increase the staffing. All right. So that to me sounds quite kind of weird because, again, if you're front running tariffs, ideally you'd like to do it before tariffs come online, because at that point, if you're doing it when tariffs are online, there's not much left to front run. Okay. But again, anything, this report could end up being true, as opposed to some of the news that we saw coming out of the Conference Board consumer surveys. But again, if I had to put my faith in one or the other, I'll keep on putting my faith in the PMIs and the regional surveys, which again are also at odds because, again, Philly Fed came in negative, Richmond Fed came in negative. Again, not great. So you have really some contrasting views between the regional surveys and the PMIs. So I'll refrain from giving you a number for the non-farm payrolls report, just because I don't know. It could come in either way. All right. Also, given the fact that last time we also saw something like that happen, all you had to do is wait for revisions, and well, the rest is history. So I'd mostly be paying attention to last month's and April's number for revisions. And again, let's see if the direction of travel for revisions is still lower, and by how much. All right. What I will say is that the unemployment rate, as far as I'm concerned, I'm still not ruling out a 10th percent increase on the unemployment rate. If not, a 2/10 of an increase on the unemployment rate. Now, again, it's also important to consider that, we have labor force participation rate shenanigans going on. Again, if you see labor force participation rate going up, that could artificially, quote unquote, move the unemployment rate higher. The opposite is true. If you see it moving lower, you can expect the unemployment rate to kind of stay subdued, if you will. Now, the labor force participation rate going down isn't necessarily, something great, but again, it's important to keep in mind when you read the unemployment rate number coming out on the 3rd of July. And again, my base case is that it comes out at 4.3. But given what we've seen in initial jobless claims, I would not rule out a 0.2% increase on the unemployment rate, similar to what we saw in last year, right? In July, when we saw that 0.2% increase in the unemployment rate, we had spent really most of that month above 220. We had 222, 240, 236, and 248. This time around, we really started off at 250, 246, and 236. All right. So that to me just tells me that the unemployment rate is likely to go up. And there is a risk that we see the unemployment rate going up by 0.2%. All right. So I won't give you a number for the non-farm payroll report, but unemployment rate, I'll say my base case is 4.3. I wouldn't rule out a 0.2% increase in the unemployment rate. Also, given the fact that we were just a smidge away from going to, from 4.2 to 4.3, the unrounded number is something like 4.243, something like that, if I'm not mistaken. So, we're close, is what I'm saying. So, again, my base case is that we see the unemployment rate moving up next week. And as far as the rest of the week is concerned, it's really a short week because, again, we have the 4th of July coming in on Friday. So what you really want to be paying attention to is, some more regional Fed surveys, of course, yes. But again, the big news will likely come out in the shape of the jobs report, the quits rate, ISM, and then non-farm payrolls. And again, if you look at the consensus and the expectations, 129, generally speaking, ain't that great, right? We're not talking about 300k, 400k, like we were in 2023, all right? You can look at the numbers for yourself right here, and even in 2022, all right, the lowest number we got in 2022 was 239, all right, eventually revised higher. And again, this is something else I stress in my videos. When the economy is on the uptrend, the BLS likely um, underestimates the strength of the economy. So revisions will likely be slightly up, all right? Or at the very least, they won't be dramatically lower, right? Like, I'll just look at one, taking one out for the sake of example here. May of 2022, revisions were largely flat. Some months had positive revisions, January, February, July, September, October, November, December. Same thing for 2021. All right. Probably 2021 is a better example of that, of how, when the economy is moving up, the BLS likely underestimates the strength of the economy. And so it has to revise it up. The opposite is true when you're on a slowdown. When you're on a slowdown, the BLS likely overestimates the strength of the economy. And so numbers have to come in lower via revisions. All right. So 129 is a far cry from the strength that we saw in 2023, in 2022, and 2021. And, that is largely at odds. I'll give you some closing thoughts here on TLT. It is largely at odds with where the long end is priced, because what you're really saying is that, the long end is right where it was in 2023 without the growth or inflation of 2023. All right. And to me, there's a lot of noise. Of course, you have Fed replacement talks, you have the big beautiful bill, you have fears of inflation coming back. But overall, to me, I continue to, go off this theme of, really the bond market being its own worst enemy, meaning every move that we've seen in the bond market has been really self-defeating. Because again, you go in 2022, from we're gonna have a recession, we're gonna have recession. It doesn't happen. Higher for longer. Inflation's gonna be well behaved. It's not. Higher for longer. It's a growth scare. Stagflation. We still seem to be stuck in this, in pricing in a stagflationary outcome. And that is probably, in my opinion, what continues to keep the long end at these stubbornly high levels. So again, I continue to go back to what I said in my earlier videos. You're likely to see the bond market kind of move in one direction or the other, depending on where the data comes out. If you see the data coming out weaker, eventually you'll see something similar to 2023, where we were pricing in a recession, and then eventually it just became clear that we weren't going to, there's no recession here, and we have to just play catch up. The bond market likes to play catch up. All right. So for instance, if next week's number is weak, you could see similar dynamics play out like in 2023, and probably like July of 2024, August of 2024, where we saw that degradation in the labor market, and eventually the bond market had to price that in. I continue to think that collectively we're being distracted by a lot of things. First it's tariffs, then it's Iran, then it's something else, it's trade deals, then it's everything except the labor market. I think we continue to give the labor market too much credit. Again, I think we continue to take growth as a given, and I continue to think that we're stuck in this 2022, 2023 environment, mentally at least, an environment where growth is sound, and so we don't really have to wait. And we don't really have to worry about anything. But again, given everything that we've been going over, the labor market is definitely weaker at the very least than what it was in 2023 and 2022. All right. So I know it's grueling because, again, you spend most of the week going up and then it just flushes down at the end of on Friday on the close. But as I've been saying in my previous videos, try not to get too distracted about Iran or trade deals, which again we haven't been really seeing, or again the news flow. Try not to get distracted by it. Try to keep your mind focused on the data, because eventually that will tell you where TLT goes. Now, will it go immediately? As I've been saying just a little while ago, no. The bond market likes to stay stubborn in pricing in whatever is pricing in at the moment. But eventually, and I stress eventually, you get to a point where it becomes self-evident, if you will. Okay, so your best ally when looking at TLT is likely going to be patience. Okay, one last tidbit. I continue to believe that, again, as I've been pointing out, we could see a flush to the 96 level on the DXY. I wouldn't be surprised if actually we bottom out there. Again, my bias towards the dollar is that as everybody moves, is extremely bearish on the dollar. I think that $96 range is a place where it could bounce. We could see a significant bounce in the dollar. Of course, it could just continue to puke lower, and then this, kind of bull flag formation right here could be invalidated. But as far as the, as long as the channel remains valid, that is my bias. So keep an eye also on the dollar. We could see some kind of final capitulation on it. And again, that's kind of my last little tidbit of information here. And again, just to close here on the TLT, I think that next week we could be the week that we really answer the question where we're going, given the fact that we have non-farm payrolls. And unless it's just, as neutral as Switzerland, nothing too dramatic, we could see it break either way. All right, we're at a point where this range is kind of getting tighter and tighter. We're right smack in the middle of the range. If it comes in much weaker, I would not rule out, just breakout to the upside, of course. And if it's, kind of red hot, as suggested potentially by the S&P PMIs, look for this circle right here, this majestic circle, which could put us at, anywhere between 78, 79 and 81.50, if you will, $82, which again would be a sweep of the previous low, just like we saw in 2006, as opposed to, having a slightly higher low like in 2010 and 2011. All right, so I'll leave it at that. Just to summarize, next week is ISM data, JOLTS report, and non-farm payroll report, as well as another read on, initial jobless claims. Initial forecast is about 240 on initial jobless claims, and continuing claims, still an increase, staying around that 1.97 area. So again, if you like this kind of content, consider leaving a like, subscribe, and I'll see you next time.